Go on, be manly.
Hello, everyone. Welcome. No, I can't do it. I can't do it. All right, let's go.
There's your intro.
Hello. Hi, guys, and welcome back to episode 5 of the Matt Talks Money podcast. This is series 2, where we talk about what they don't teach you in school. We've got joined again by Ollie. Thank you for coming back again.
Hello.
Episode
Sorry, I
5.
can't lean into a mic this time because it's
No,
would love me. But
So this is episode 5. Last episode we talked about budgeting. Today we're going to be talking about investing, which is a topic that I always thought was scary and taboo, sort of like credit cards. And I always thought it was, only the mega rich can invest and all this kind of stuff. I don't know if you thought the same growing up, Ollie.
well, I was always taught about saving, not so much about investing, because my parents always kept that side of what they do very private. But it's fun. It's good fun, and it makes you more money.
Yeah, I mean, saving is great. But I think, as we said in the savings video, you're limited to the interest rates, whereas in investing, potentially limitless, I suppose. If you invest in certain, more limitless than savings.
Yeah. Okay.
Because I always brought up with, not brought up, just society, I think, was like, oh, investing's bad, it's really risky, you should put your money in a savings account rather than trying to risk it in some, random startup. But once you start doing some reading about investing, I think you realise that it doesn't have to be as risky as you think. It's actually, I personally think, a method of investing can be safer than keeping money in a savings account in terms of not losing money every year.
Yeah, no, I'd agree. I think before you can read all you want about investing, but I think the best way of learning how it works and what to do and what not to do is just by doing it. It seems a very daunting thing to do before you start doing it, but I mean, apps like Free Trade and Trading 1212 have made it much more, I wouldn't say much easier, but much
easier than
scary.
Probably when our parents were kids and the
Yeah,
only way
okay,
to invest.
yeah.
I don't know how you would invest back in those days.
Who cares?
Yeah, no. Free Trade and Trading 2 are very good. It probably brings us on to talk about our investing journey. So my investing journey.
Hang on, before we do that, Matt,
go on.
What is an investment?
What is an investment? That's a good chart, actually. The investments we're talking about in here are investing in companies by buying a share of a company. So like buying a section of Tesla. The word investing, though, in theory could mean multitudes of things. It could mean if Ollie was starting a business and I gave him some money, that's an investment into his business. Or you invest in, random things like Forex or things like that. But the investing we're going to be talking about is buying a part of a company and hoping that section of the company you have will be worth more later down the line.
So, when we say buying part of a company, it doesn't mean that you own every office chair on the 4th floor. That's not what we mean. We mean so.
That's how I thought it worked when I started, to be fair.
Okay, well, this is a good way of clearing it up. It's not like individual items. It's more the total net worth of the company. You say you own 1%. Say your net worth, I don't know, is £1,000. If your net worth of a business is £1,000, your business is not very good. Then if you own 1% of that, that is £10.
Yeah.
So if that company was to sell tomorrow, I was just mental maths. Is that right? If that company was to sell tomorrow, they would have to give you £10 or 1%.
Yeah. So there's also a few ways you can make money from investing. There's growth and then there's dividends. So let's say I bought into Ollie's company. I bought 100 quid of Ollie's company, I don't know, Espresso Goods or something, because he likes coffee. And then my hope was that next year that company might be worth £150. So if I was to sell my share next year, I'd make £50 profit. That's growth, and that's what I would say, long term is what I'm looking for, growth stocks rather than dividend stocks. A dividend is a amount of money the company will give you, like a reward for buying that stock or that share. So, for example, Apple pay, I don't know what percentage, for you to have a share in Apple. So every now and again on my free trade, I get like, 5p from Apple, whoop-de-doo. That's a dividend, but that's only because I've got minimal amounts in free trade. So longer term, if you had hundreds of thousands of pounds in investing, you can be making a sizable chunk of income just from dividends from stocks.
Yeah, I mean, dividends is kind of like an incentive for you to invest in that particular company.
Yeah, exactly. The only thing with dividends is, not all companies give dividends. Typically, the dividends are a percentage of the company profits. So if 1 month the company isn't making any, or 1 year my company isn't making any money, they're not going to give you a dividend at all, are they? And they can choose what dividend they pay, or if they don't pay dividends at all. So it's not a reliable source of income.
No, you're looking for an ideal investment is to invest and get 1% share of a company when that company is really low, and then years down the line that company is then worth 10 or 100 times more than what it was when you invested in it, but you still have that 1% share. So even though you only put in X amount when you first invested, that is now worth Y amount as if you were to draw it out. So that's when they talk about like 10 times and 100 times growth, that's what they mean.
Yeah, but see right now, if you try to get 1% of Apple, it's going to cost you a load of money.
Yeah.
If you want to buy, I know it's not the same, but if you maybe 10 years ago you bought 1% of Tesla, it wouldn't be a lot at all.
And so then there's the other side of it, which is the way that free trade do it is you're not sat there going, I'm going to buy 1% of. Let's take Tesla. So you don't go on free trade and go, I want to transfer and buy 1% of Tesla, because that's not how it works. You can buy fractional shares. So whatever you can afford, the current market price of Tesla will then be broken down to. So let's say the market price of Tesla is £100 a share, right? And you can only afford to do £50. That means you get half of the share, right? But then the hope is that the market price of Tesla in a month is £200, but you still have half a share of that, which is then £100. So you've then doubled your money.
Yeah,
so that's how that side of it works.
I was actually looking into it. I think free trade is better than trading 212 for fractional shares. I was trying to buy.
It's better in every way.
The only issue is, we'll talk about this. So let's talk about. So how I first started investing was I found free trade, I think on the App Store or something, and I started investing in it willy-nilly in a general investment account, which isn't an ISA. And if you've watched our ISA videos, we say invest inside of an ISA. So now technically all the cash that's in my free trade account is liable to capital gains if I was to sell it. But of course, I don't want to sell at the moment. So the only issue with free trade is they charge you a £4 fee a month for an ISA.
Yeah.
So that's why this tax year, a few days ago, I opened a trading 212 ISA, which is free. And now every month I'm going to be putting money into there. But like I said, I do prefer the interface of free trade. It looks a lot nicer.
Yeah, and it's much cleaner and it's less sort of like what is going on. It's very these are the companies you have invested in. This is how much you've bought. This is the current value of that, and it will tell you if it's gone up or down. And you can see the market from the last day, the week, the month, the year, etc. I
do like on Trading 212 they have a pie feature. Do you know have you heard of the pie feature?
I haven't, no.
So let's say you have £100 to invest. Rather than going to buy, put £10 here, £10 there, you create your own pie with the companies you want. So you might put Tesla, Apple, Google, all that kind of stuff in it, and then choose how much of the pie you want to be allocated to that stock.
That's cool. Yeah,
and then you invest into that. So I now invested into a few different pies, which are quite interesting.
That's good. Yeah.
But yeah, so my journey started with free trade, and then it's moved into trading 212. What about yourself, Mr. True?
Well, I mean, so last summer, I think you introduced me to free trade, and we spent about a week of our holiday just looking at investments, which was really sad. But it was quite good fun, but all our mates took the piss. To be honest, I haven't, especially this year, I haven't done a lot of sort of investment trading. I've sort of just put some money in it and just sort of left it, so being quite passive. And again, going back to the whole ISA thing, you can open an ISA for trading if you want to, and then do all the investment yourself, and know that any gains you make are tax free. Or if you don't want to be that active with it, you can then open stocks and shares ISA anywhere. Doesn't have to be with Trading 212. It could be anywhere. So Moneybox is a good example. You can just put it in. You can tell them how passive you want to be with it and how like risky you want to be with your money. So you can be very sort of very moderate and be like, most of it's 60% is going to go in cash funds. And they have a pie chart of telling you the breakdown of what they're going to invest in for you. But they'll then go and do the investing for you. So you can have, I think I've done like a moderate one, which is sort of average of 8.7% over the last sort of 8 years per year. So you get 8.7% growth, which when we talk about savings accounts is much higher than any savings account you're going to get.
Yeah.
And then there's the risky one that has an average of like 9.7, but obviously there's some years where that's gone down and some years where that's gone massively. So that's more of a long-term thing. So that's kind of been my approach to it. I haven't been as active as you have, especially with stocks and shares investment.
You did dabble in currency, didn't you?
Yeah, I did. So I suppose my first like big experiment was I used to live in Australia, so I have an Australian bank account. So during COVID, I was keeping an eye on the Australian dollar to the pound, and I saw that it dropped. So the pound, the ratio was quite big. So then I moved a bunch of money over to Oz. I mean, it wasn't a lot, but I moved it, and every week I would check, and slowly my English money compared to how much Australian dollars I bought at the time was then kept going up and up and up, and then it dropped a bit. So I suppose that's a version of forex trading, isn't it?
Yeah. See, there's trading and there's like
currency exchange.
Yeah, there's like when I think of investing, I think long term. I don't just buy a company. You know the whole GameStop thing. I wouldn't just buy it and then sell it the next day. Forex is more day-to-day trading. It's more trading rather than investing, but it sort of counts as investing a little bit. Put your money somewhere. You know, you put your money to work. That's an investment in some senses.
And I suppose, but people say that trading is gambling, which I do agree with, especially if you're doing it short term. It can be you don't really know. But something like currency, I've been very aware of the trends of the Australian dollar compared to the British pound over the last 10 years. And I knew that when it drops that low, it is going to come back up again. So at some point it will come back up and it will bounce back. So I've got quite a safe bet that if I move that money over, it is going to make me money at some point. It might not be straight away. It might drop even further, in which case, yes, it's a bit annoying because I could have waited and made more money, but you're sort of aware that it will make you money eventually.
Our other side investment, if you want to call it, is we'll talk about is crypto, isn't it?
Yeah, that's been the big one.
Yeah, so we both. Well, I think when was it? January time, maybe. Something like that. I think it was me who sparked the conversation with me, Ollie, and Jack Bennett from the first season of the podcast about investing in Bitcoin and Ethereum. But again, I think the general consensus between us three is we bought X amount and we're now just going to leave it long term. Yeah. I don't personally tend to sell it for a very long time, maybe ever. I don't know.
Well, I suppose you don't really know. You don't know what's going to happen. You can't be like, I'm leaving this in here for 5 years and then I'm taking it out.
I just want to see what happens and just go along knowing that I own a bit of it.
But I'd much rather. Yeah, you're right. I'd much rather be on the other side of knowing what happens, as in a bit of my money is on that side. If it crashes and burns, great. I haven't put enough in that I'm going to miss. But if it does really well, suddenly that's a massive chunk of money that I didn't have or wasn't going to have before.
Yeah.
But you and I have been quite active in that side of it, and I think have done a lot of research and figured out what was going on. Because when crypto first came into my I was aware of it. It was like 2010, and I was like, oh, there's some what does that mean? I have no idea what that means. There's something there's some financing, and then when it started peaking again and people started picking up interest, I then was much more interested because I was of an age where I actually cared.
Yeah, well, they say the best another type of investment. The best investment they say is to invest in yourself. For us to go and sit down and read about crypto, and that's why I try and read all these personal finance books and all that kind of stuff. that's investing in us. Also, a little hint to next week's episode, which is about side hustles. We have both actually invested in side hustles because we both do drop shipping, but that takes some cash to start up with because it's hard to start a business, a side hustle, without any cash.
And then I suppose that's kind of as you said, an investment in yourself because you have to fork out money and give it to a scheme and a system that you then have to work at. And everyone, 9 times out of 10, people our age would be like, "Well, I'm spending money and I have to do work. What? People should pay me to do work." And I'm like, "Yeah, but it's not how it works."
See, I was talking to someone, and it's interesting because we both bought a course for the dropshipping. If the course was free, I would have zero incentive to make this work. But because I've invested some of my own hard-earned cash, I now have an incentive to make it work. But yeah. A fun little quote for you, Mr. Trigg. I wonder if you can guess who said this. Compound interest is the 8th wonder of the world. Any idea?
Well, I'd love to sit here and guess, but I've got the same Notion document that you have up, and I know that that's Albert Einstein. Sorry. Albert Einstein, sorry.
Absolute cheat looking at the Notion document. Yeah.
Well, you told me to put it up before we started.
But yeah, and then he goes on to say, those who understand it earn it. Those who don't understand it pay it. We talked about interest back in the second episode on savings, but yeah, it can be a killer, but it can be great. With investing, you don't actually earn like interest as such but that's just like how you can estimate a growth of a stock by estimating it. But yeah, so like Warren Buffett, like one of the best investors of all time. He's only made half of his money in the last few years because every year it's just now doubling or something stupid because he's like 89 or something.
Yeah.
And this is why my personal investment strategy, now the world will know, it's not major, is to put whatever an X amount a month that I can afford at the time of my income into index funds. I suppose it's prominent to talk about what an index fund is, Mr. Trick.
Yes, you should talk about that.
So when you're investing, right, you could go and invest in Tesla or Apple or all this kind of stuff, which has some kind of risk to it because Tesla could go bust tomorrow. They probably won't, but they could. An index fund is like a basket of all these companies. So the best, probably well-known one is the S&P 500, the 500 biggest companies in the US. That includes things like Apple, Google, recently Tesla. So the chances of all 500 of those companies going to zero is minuscule, pretty much impossible. So for you to lose all of your money you invest in them is pretty much impossible. I'm not saying you won't lose some money year to year, but on average over the last 50 years, it's averaged 8 to 10% a year. But what that means is 1 year it might have gone down 20%, and then the next year it's gone up 13% or something. It's an average. So what I'm going to do is invest in a fund like the S&P 500 or the All World Fund every month, and just keep it for the long term in an ISA, so that over the course of the next 40 years, it will.
So hang on, okay, questions. Who hosts your index fund then?
So my index fund is actually hosted by Vanguard. The reason I haven't used Vanguard directly is because they have really cheap fees. I think it's like 0.15%. But because on Trading 212, I can invest in individual stocks as well as the funds. On Vanguard, it's limited to just their own funds.
So Vanguard then go and choose of the 500 companies which to invest in, or what?
No, all of them. All of them.
Oh, so it puts the same amount in each one.
The weighting, I think, does vary depending on. So, like for example, when Tesla came into the S&P 500, a company would have had to leave the S&P 500.
Yeah.
I think that's how it works, and that is like a regular review type thing. So Vanguard will adjust my holdings accordingly.
Right. Okay.
But yeah, that's my, and I would say that's actually very relatively safe. I mean, I'm invested in two funds, the All World Fund from Vanguard and the S&P 500, which is the US. So either the whole world goes to zero or the US goes to zero. I don't think it's going to happen anytime soon because I'm so well
But we didn't think Trump was getting in, so don't say.
Yeah, this is true.
Never say never, mate.
Mr. Trigg, what does diversification mean? Because my funds are hella diversified. What does that mean?
Well, I don't know dictionary definition, but from the top of my head, I can assume that it's investing in a well-rounded source of funds and shares, and make it very, opposite ends of the spectrum. Not all in tech or not all in shipping. Or whatever.
It just means to spread it all out. You spread your risk out, but you also then spread your return out.
Yeah.
If you invested £100 in Tesla 10 years ago, I don't know how much you'd have a lot of money right now, right? But if you invested £100 in the S&P 500, you wouldn't have as much money because the risk is lower, but also that means the return is lower. So I've diversified my risk, but also I take the hit on the return. But it's still more than you get in a bank account.
But then, so if you say you invested £100 in Tesla 15 years ago, so that's what? Let's call it 2005.
Mm-hmm.
During 2008, Tesla were running out of money very, very quickly, very, very fast, and you would keep an eye on that and be like, "Oh my gosh, pretty much all my money's gone." And then it's the call of, do I take what I have and just cut my losses and just take it out, or do I wait for them to bounce back? And there's a lot of people that would have just taken their money out and be like, "Yes, I've lost it, but I've still got X amount. Let's go put it somewhere in which it's gonna actually do well before it just crashes and burns." But then obviously Tesla had that massive rise, and now the worth. I don't even know how much they're worth. But
a lot of money.
It's that I suppose is the gambling side of it, in terms of you don't know what that unless you can do hours and hours of research, but you don't know exactly what's going to happen to that company.
Yeah, but that's why I only invest. I look at my free trade and my trading 212 because I find it interesting to see how the news affects or something. But I won't sell. I don't have any intention of selling stuff in there because that's the. If you sell when the S&P 500 is down 20% in 1 year, you've lost 20%. Just your luck, it will go up 16% next year.
Yeah.
But yeah.
So once your money's in somewhere, right, in a particular thing, you are very much of the opinion of put more money somewhere else rather than take out that money.
Correct. Once it's in trading 212, I don't expect to take it out.
There must be a scenario where you look at it and go, "Oh my gosh, I've lost so much. Let me just take it out." Or is that not how you work at the moment?
Not in what I'm invested in trading 212 because it's so diversified.
And it's always you're doing it sensibly, and you're doing it every month from the amount of money you can afford to do.
Someone said, I don't know where the quote's from. When in doubt, zoom out, and that means look at the chart. If you're looking on a 7-day chart, look out to a month and then to a year and then to 10 years. And you might be going down, but in the scheme of things, you're still going up. So once my money's in trading 212, I see that as not having that money anymore as such because I don't think it's withdrawable. My free trade is a different story. If I had to withdraw, that's sort of a second emergency fund for me. If I had to withdraw, I would because I know I'm going to get taxed on it later in life anyway. So I might do that. But trading 212, I'm not going to touch now.
Cool. Yeah, very sensible.
Time for a bit of maths. So, I don't know if there's actually, we're both students, and I think if you got a part-time job, I reckon you could easily earn £100 a month spare that you either could save or invest. Easy, I reckon. Yeah. If you put £100 a month for the next 40 years, so when we're 60, into a fund such as the S&P 500, which we're going to average at 8% a year, you'd put £48,000 in.
Over, so what? So 1,200 over 4. Yeah, okay.
Yeah. But this estimates that you'll have £322,000 by the end of it.
Damn.
That's the power of compounding.
Damn. Yeah.
£322,000 off a £48,000
If that doesn't make sense to you guys, go and watch Matt's Rice video on his TikTok.
Or simply just Google compound interest calculator and just type in.
No, don't do that. Go and watch Matt's Rice video and then go and Google.
Yeah, there you go.
There you go.
But yeah, if you are completely new to investing, first of all, do a bit of reading around it. It's not as scary as you think it is. I think if you want to start again investing, open a Trading 212 or free trade ISA and just invest what you can afford to not touch in something like the S&P 500 or a fund. You know, the FTSE 100 is all the companies in the UK. Something that is typically going to go up over time. I think that would be my tips.
So yeah, I mean the tips are like, obviously, first of all, do your research. So obviously that's probably why you're here, because you're probably trying to do research. Second of all, diversify. Don't add everything to everything.
And hold for the long term.
Yeah, and don't worry about small losses.
That's why I said, that's what my answer to your comment about would I sell it? No. The prime example was I didn't have much. I had like 20 quid in National Express and it was down. No, sorry, I had 40 quid and it was down 46%. So it was down to about 20 quid. It's not a lot of money, but it's now gone back up to 3%. So I've now made like £3 or something, you know. So, that, you know, that's proved to me that holding for the long term does work.
Yeah, very good.
In general, if you wonder why the market goes up in the general, go study economics and why economic growth is a thing. If it wasn't a thing, we'd never be improving and the whole world would go to crap. But yeah, long term, everything will go up. That's how it works. But yeah, any last comments, Mr. Trigg?
No. Get investing, cool. Guys. Just but only put in what you can afford.
So, and if you only have £100 or £1,000 to invest, and you're at a young age, I don't think it's personally worth putting it into index funds or something, because you're not going to get a high return unless you can invest monthly. Instead, what you can do is invest in yourself by watching the next week's video where we talk about side hustles. Yeah. Where you can invest that £1,000 into various side hustles, which could make you more money, which you can then invest.
Or get a job.
I
know that's hard. I know that's easier said than done, but I would make that a primary focus. Investing is probably great once you have monthly income to fund it, but until you have that, yeah. Work
on increasing your income. Cool. All right. So we're back next week with a side hustle video. Thank you for joining, Mr. Trigg. And we'll see you guys next week. Bye, everyone.
Bye.